And of course, higher interest rates has a very, very strong and bearish impact on gold pricing.
Big news coming out of the gold market this week. Well, not really news, but the price itself makes the news. I always say that to the guests, especially yourself. Actually, I think you're the one who taught me this. The price makes the news. So 1742 was the latest price. Yeah, 1742 is the latest price that I'm looking at right now. This is the first time that you and I have spoken since gold has broken below $1,800 an ounce. And it is a dramatic move downwards. It is a very sharp move downwards, and it's caused concern for a lot of gold investors. So what can you tell us about this recent move? What caused this sell-off?
Well, the underlying forces causing the sell-off is the continued reaction to interest rate hikes by the Federal Reserve. It's not so much that they've raised rates incrementally and consistently over the last 3 FOMC meetings. It's the fact that they began with a 0.25% rate hike, 25 basis points in March, followed that up with a 50 basis point rate hike the following FOMC meeting. And then, of course, in June, they went to 75 basis points. And 75 basis points is a rate hike that is not that open, or it's not a rate hike that one would typically expect. It's rather large. And the fact that they most likely will raise interest rates by another 75 basis points at the FOMC meeting this month.
Okay. Now, you have previously told me that once gold reaches $2,000 an ounce, I believe it is, we're going to see a major bear market, major reversal. It doesn't look like we're going to hit $2,000 an ounce anytime soon, though, is it? Based on the current charts, would you say the momentum is stronger on the downside still? Or do we have any rays of light for the bulls here?
Well, right now we are firmly entrenched in a bear market. There's absolutely no denying that. The key about what many analysts have been looking at was the spiraling level of inflation. And the focus upon that is what drove gold to higher pricing. But it did top out very quickly because the real concern then became how the Federal Reserve is going to react to it and whether or not that will have a profound impact on levels of inflation. They've raised interest rates, but a lot of the inflationary pressures are sticky, persistent, and cannot be controlled by reducing demand. It's supply chain issues and bottlenecks, the war in Ukraine, and the effect that that has had on oil prices. And oil is such a critical component to all industries. If you're producing a product that doesn't require oil to manufacture, you've still got to ship it. So that's been the primary drivers of inflation. And the focus has absolutely shifted from inflationary pressures to the level of interest rates. And of course, higher interest rates has a very, very strong and bearish impact on gold pricing.
Speaking of interest rates, if you take a look at the yield curve, 10-year minus the 2-year, that's inverted. That's not good. Typically, an inverted yield curve leads a recession. So what's next?
Well, that is the common adage, so to speak. The way that I tend to look at an inverted yield curve is that it is a knee-jerk reaction to interest rate hikes that will tend to work themselves out of the system naturally over time.
Yeah.
A yield curve that is inverted for an extended period of time, in many cases historically has led to, or was followed by, a recession, I should say. So there's very good historical data to back that assumption. The question becomes whether or not the Federal Reserve can pull off lowering inflation and having a soft landing. And I'm on the side that that will be very difficult, if at all possible, for the Federal Reserve to continue to ratchet interest rates higher and not have a really profound effect on the economy. Up till now, it hasn't. The most recent jobs report today came in over The forecasts, I believe the forecasts were at around 250,000 jobs added last month. The number that came in was over 300,000. So it came in above expectations. The key to what we've seen in gold, more than anything else, or I would say as important as buying or selling pressure by traders, has been dollar strength or weakness. Recently, we've seen tremendous dollar strength. It's moved above a 20-year high. And of course, there's an exact inverse correlation between dollar strength and gold moving down. Or actually, the correlation is a positive. It's a 1-for-1 because gold here is paired and priced against dollars.
Yeah.
You will see that in other countries, for example, in Switzerland, when you look at it against Swiss currency, it has not had the same kind of sell-off that we've witnessed for those that look at gold and pair it against the dollar.
Now, this is an interesting piece of news that ties into the dollar. I'm just going to read the headline of this article dated June 24th. It says, Russia and China are bringing up a challenge to dollar dominance by creating a new reserve currency. First paragraph of this article by Markets Insider reads, Russia is ready to develop a new global reserve currency alongside China and other BRICS nations in a potential challenge to the dominance of the U.S. dollar. President Vladimir Putin signaled the new reserve currency will be based on a basket of currencies from the group's member countries, Brazil, Russia, India, China, and South Africa. It looks like a lot of countries, especially in the developing world, are trying to de-dollarize, and long-term analysts speculate that this could mean the end of dollar hegemony. Do you agree? And what does this mean for gold?
You know, I don't know what the final outcome will be. I can say this, that it's always been a desire of, especially Russia, and to a large extent China, to not have the US dollar as the primary standard for transactional events between central banks and large institutional hedge funds and things of that nature. The dollar has been the go-to currency ever since the end of World War II. And prior to that, because of the gold reserves that the United States had built up after Roosevelt's action back in the 30s of having citizens turn in their gold in exchange for fiat currencies. In other words, once we went onto a fiat currency, the dollar has been the go-to currency. Of course, that is what China and Russia would want to do more than anything, is not have it fixed to the dollar. In the case of Russia, we've boycotted dollar transactions after they went in and invaded Ukraine. So their business and their ability to transact international business has been severely hampered because of that. So to have the dollar lose its importance in terms of it being at the top of the heap, in terms of an international exchange, would benefit Russia, and it would benefit China, to some degree India. But China and Russia, it would definitely be, it's on the top of their wish list. Will they be successful in that? Only time will tell. But they, especially in the case of China, continues to get more powerful month by month, year by year. So inevitably, another currency might in fact challenge the US dollar, but I don't think that that's going to be on the radar relatively soon.